Welcome to the Fear and Greed Business Interview. I'm Adam Lang. It's a new financial year, but investors aren't exactly getting a clean slate. Despite some strong recent performances like the S&P 500 hitting a record high and the Australian market notching its best 12-month run since COVID, global uncertainty is certainly in the spotlight. In the words of global fund manager VanEck, the risks and narrative for the next quarter is as clear as mud. That's a great quote. VanEck's latest ViewPoint report suggests we're entering a period where traditional safe bets like US equities and bonds no longer offer the same rewards, whereas opportunities are emerging in places that have long been overlooked. Remember that this is general information only, and you should seek financial advice before making any investment decisions for yourself. Cameron McCormack is Senior Portfolio Manager at VanEck, and I'm delighted to say he joins me this morning. Cameron, welcome back to Fear and Greed.
Thanks for having me.
The VanEck statement saying that the market and the outlook is as clear as mud. Why?
It's a bit of an oxymoron, and I think if you reflect on where we are in terms of the global economy, we've got obviously the trade discussions ongoing with the deadline coming up. Obviously, there's heightened geopolitical risks. And if you think about the market rally we're seeing across the board in Australia, in the US, a lot of the indices are near or at their all-time highs. And if you look at valuations, particularly in those segments, particularly the growth segments, they're looking quite stretched. So from really balancing up those injunctions leaves us in a tricky place.
Those Independence Day tariffs and high valuations, as you say. Amongst that, what do you think is the biggest risk that investors might be underestimating right now?
Yeah, I think there's a lot of market exuberance at the moment, particularly, and that's reflected through, obviously, the rally we've seen of late and valuations. I guess the key risk to really consider is certainly the ongoing tariff discussions. And we know that, obviously, the global economy has really got that baseline 10%. Now, there are obviously trade deals that have been announced with the UK. It looks like Europe's in a good place, clearly, I guess, from what we're hearing so far, which is positive. But having said that, those will have an impact, particularly on the US, in terms of, obviously, inflation. And we're starting to see that when you look at some of the underlying IMC manufacturing data inputs, in particular, prices paid, that has picked up. So if you take that on face value, I think the back end of the year could be a bit more turbulent than what the market seems to suggest.
The US is still the most powerful economy in the world. Are US equities still worth the weight that they carry in global portfolios?
They're certainly an important part of a global diversified portfolio. They're roughly 70% of the MSCI World Index. And if you look at, obviously, the last 15 years, they've been a stellar performer relative to Europe, even Australia. And, that really does come down to the Magnificent Seven. They're clearly, pioneers in driving technology, particularly across AI and cloud computing. Having said that, certainly China's catching up as well. But the key headline risk when we think about the US economy is certainly their fiscal outlook. We know that the beautiful bill has just been passed, which is quite promising. But having said that, it's going to further extend their fiscal debt relative to GDP. It's sitting at about 100%, and it's projected to, I guess, increase further. Now, we've started to see, if you look at the long end of the curve, stay quite fixated at that 4% range. It did tick up about 10 basis points last week. So from that backdrop, the market is trying to weigh up, while the US is in quite a strong position at the moment, that fiscal backdrop and certainly the medium-term implications of that as well in terms of servicing that debt.
Cameron, do you think amongst all those factors, is it too early to say that US exceptionalism is heading towards an end?
Yeah, I think it is. It's an important, I guess, reflection point. Certainly when we look at US equities, they've been such a strong performer, of late. If you look at year-to-date performance on a local currency basis, Europe, Australia, and the US are almost neck and neck. And if you think about, I guess, where we are in terms of, conjunctures, there's a lot to weigh up when we think about, I guess, positioning portfolios, particularly when we think about the forthcoming 2026 financial year.
Cameron, VanEck is favouring emerging markets in fiscal 26. Why are you looking at it that way, and what makes some emerging economies more resilient than others right now?
Yeah, so if you think about, particularly when you look at the US dollar year to date, it has weakened quite a bit. We haven't seen those type of moves for quite a period. Now, asset classes that typically do outperform when USD weakens is emerging markets. they're net credit exporters of the US dollar, and they're also commodity exporters. So from a fiscal standpoint, if you look at, say, the US, which is running a government debt relative to GDP of around 100%, emerging markets are quite considerably lower. So from a fiscal standpoint, they do look better on a relative basis. And certainly when you look at valuations for investors looking for, I guess, better relative value, emerging markets are trading at a circular, 35% to 40% discount across a range of metrics compared to developed markets. So if we do start to see a potential rotation into value again, like we saw at the start of the year, emerging markets have fared quite well, given the uncertainties around tariffs and like.
Stay with me, Cameron. We'll be back in a moment. I'm speaking to Cameron McCormack from VanEck. Cameron, the gold rally, do you think, it's come a long way already in the last 5 years. Do you think it's just getting started, or do you think it'll taper off?
Yeah, it's an interesting point to reflect on. If you look at the where the gold price is at the moment, it's $3,300. It's rallied quite substantially, even year to date as well. Having said that, there's a lot of structural tailwinds when you think about the gold price. There's been quite a considerable amount of central bank buying, particularly from emerging markets, again, looking to diversify away their reliance on the US dollar. And certainly with, I guess, Trump's presidency, he's looking to, well, as a response in terms of the emerging markets, they're really trying to diversify, again, their reliance on the US dollar. And naturally, gold is a way to fill that void. There's also the fiscal backdrop that we've talked about in terms of the US economy. If that does become more of a near-term challenge, that could certainly be a further tailwind for the gold price. And certainly with ongoing tariff discussions as well, and policy uncertainty around that, that's certainly a period where the gold price typically does outperform. If we do start to see inflation expectations pick up, we would have seen even last week as well, the market's really dialed down expectations for another rate cut in the US. That's really effectively ruled out a rate cut in July. It's a very different story, obviously, in Australia. But all these components are quite positive for the gold price, even despite the rally we've seen of late.
Wow. So amongst the asset classes, do you see one that you think is being totally overlooked?
Yeah, so it's, I guess, probably another step down in terms of the gold complex. There's certainly gold miners. Now, they've been another, I guess, stellar performer. They've actually more than, I guess, doubled in terms of year-to-date performance relative to gold. But if you look at their valuations, they look quite attractive in terms of where the current gold price is relative to their fair value. It's sitting circling around a 20% discount. Now, the other component in terms of gold miners as well is that if you look at their really evolution over the last 10 to 15 years, their balance sheets have improved quite substantially. So they're really deleveraged, which is quite positive.
Over that period of time.
Correct. And they've improved their profit margins. So what I mean by this is, despite the gold price, increasing quite substantially, their all-in sustaining costs have leveled off. And that's created, I guess, quite a increase in the profit margins. And we haven't necessarily seen that reflected in the performance of gold miners relative to the gold price over sort of the last few years. So there could be further upside if I guess more of a value rotation does come back into play.
So let's look at the Australian market in general. It's had some good runs, and compared to other markets, it's maybe seemed to outperform them. How long do you think that good run can continue?
Yeah, it's been an interesting sort of, I guess, complex when you think about the Australian market. Obviously, the standout's been CBA. It's been quite a remarkable run over the last even 12 months. And if you look at as a weighting relative to the ASX 200, it's gone from around 9% to around 12%. Now, I think it's broadly considered to be true that, I guess, CBA relative to the other banks is considered a more of a, I guess, quality name. But having said that, if you look at where valuations are of CBA in particular, it's at 29 times. And that's almost double its historical average. That's the same multiple as the Magnificent Seven, despite the divergence, obviously, in earnings growth. Magnificent Seven have been coming out quite considerable, strong, free cash flow margins. And we take CBA, or while it has, I guess, grown, certainly not to the same degree as some of the, technology names in the US. So if taking that complex, it's quite an interesting, I guess, juncture we're at the moment. And I think when you think about the Australian market, obviously it's very concentrated across financials and resource companies. Now, because particularly iron ore miners, BHP and Rio Tinto, they've been quite structurally out of favour for the last few years. And what you typically see is that when Australia's banks outperform, typically Australia's resources underperform. So if you do start to potentially see a rotation back to resources, that could be a potential headwind for CBA in particular. So certainly, considering how concentrated you are when you're investing in the Australian market, it's quite important.
Got it. So on the other side, what sectors are looking risky and investors might really question in the near term?
Yeah, I think there's a lot of, headline, risks considered. Obviously, the medium-term implications of tariffs being implemented and how that has a flow-on effect for the US economy, but also the Australian economy as well. Now, generally speaking, the Australian economy is considered to be more insulated from the tick-to-tack in terms of how that's unfolding. But having said that, it does have flow-on effects for the Australian market. Now, if you look at pockets of valuations, particularly we've talked about CBA in particular, it's looking quite stretched, particularly on a historical basis. That's certainly an area to watch quite closely. We have started to see a bit of a rotation to resources recently. It hasn't obviously been quite structural, but it's something to watch quite closely. Another area is certainly consumer discretionary names in Australia. Retail sales have started to weaken a little bit, but it's important, having said that, to be, I guess, diversified as well across sectors as well.
Makes sense. Cameron, thank you very much for talking to Fear and Greed.
Thank you.
That was Cameron McCormack, Senior Portfolio Manager at VanEck. This is the Fear and Greed business interview. Remember, this is general information only, and you really should seek professional advice before you make investments. Join us every morning for the full episode of Fear and Greed. It's business news you can use. I'm Adam Lang. Enjoy your day.